welcome, good morning. You're watching Market Cafe with me, Snehi Shah, and with me is Shreyansi Singh. You're watching ET Now. Thanks so much for choosing your day with us. Well, it's a Friday morning, and Shreyansi, take us through what the global handover is looking like, because I believe not very good moves coming in from the US, and we also have some key data points, right?
Absolutely, and it's very interesting what we're seeing playing out with the US markets, because right now when you look at S&P 500 futures, though they rose in overnight trading, this was of course as big tech names Alphabet and Microsoft saw shares rally on strong earnings. So futures linked to the broad market index climbed 0.7%. When you look at Nasdaq 100 futures, they popped 1% also, and futures on the Dow Jones Industrial Average also gained 30 points, or just about 0.1% thereabout. And when you look at shares of Alphabet, of course, they jumped 11% in extended trading following a better than expected first quarter earnings. Now, the company also authorized its first ever dividend the company also authorized its first ever dividend as well as a $70 billion buyback. So that is an announcement that we saw from Alphabet. When you look at Microsoft, then the shares climbed 4% after the software maker posted fiscal third quarter results that surpassed Wall Street expectations as well. But now also when you look at the broader indices, what you're looking at is that the strength in these mega cap stocks that we've seen of late could also give the major averages a boost after a losing day on Wall Street. So largely when you look at the day that we saw yesterday, the blue chip Dow slid 375 points, while the S&P 500 as well as the Nasdaq Composite dropped just about 0.5%, 0.5% thereabout, and 0.6% thereabout respectively. Now when you look at this sell-off and what this was triggered by, like Snehi rightly mentioned, there was of course data that was playing in the picture. Thursday's sell-off was largely triggered by new US economic data that showed a sharp slowdown in growth and pointed to persistent inflation. Now, when you look at gross domestic product, that expanded by 1.6% in the first quarter compared to a Dow Jones forecast of 2.4%. Meanwhile, the personal consumption expenditures price index also for the period rose at a 3.4% pace, well above the previous quarter's 1.8% increase. So that largely is the handover that we saw coming in for the US markets. When you look at European markets also, what you saw is that they closed lower. So when you look at the Stock 600 index, that closed about 0.6% lower thereabout, and most sectors were in the negative territory. So that largely is the handover coming in from Europe as well.
Well, absolutely, and with that, let's also take a look at what's happening with oil, because lots of factors weighing in when it comes to oil prices as well. So let's understand what's happening with the oil market largely. And so crude oil futures have risen yesterday, and this is the market on the back of market weight disappointment coming all across the US on the back of its economic growth again and potential geopolitical risk from a looming Israeli invasion of the southern Gaza city of Rafah. Now, like Shreyansi mentioned, the GDP data is subdued in the session and a little lesser than what the street was penciling in. But traders have also realized that the oil market is tight and the situation in the Middle East continues to remain foggy. Now, in the Middle East, Israel is launching airstrikes on Rafah as the country makes preparations to invade the city, despite warnings from allies that such an operation would compound the humanitarian crisis in Gaza ongoing right now. Now, on the back of this, West Texas Intermediate, which is the WTI June contract, closed at $83.5 a barrel, up 76 cents or almost a percent. Year to date, US oil has gained more than 16%. Now, Brent contract for June also closed at just above that $89 per barrel mark, up 99 cents or 1.1% coming over there as well. Year to date, this global benchmark has added more than 15% as well. So largely, this is what is happening in the world of oil. Let's also take a look at what's been happening with crude, with gold then. And gold seems to be rather steady as of now at $2,340.9 per ounce. So that's where gold is at right now. These prices did rise yesterday as US Treasury yields rose after economic data showed signs of persistent inflation, lowering the hopes of the Fed Reserve cutting rates anytime soon. So on the back of these numbers, we're expecting some volatility to come in the US markets as well. On the back of that, people are expected to resort to gold more than ever, as gold is considered to be a safe haven asset as well. So some price movement can be seen in gold as well going ahead. But largely, well, yes, that's the handover coming in from what's been happening in the world of oil as well as gold.
Absolutely, and there's a lot of cues to keep an eye on, especially today, because in India you do have the phase 2 Lok Sabha election in 89 constituencies that kicks off. So that will be something that will be keenly watched out. Now, when you look at global cues, then from the US, you do have Fed's balance sheet and PCE price index data coming in. You also have Baker Hughes oil rig count, and that data set is of course keenly watched and will remain in the spotlight. But also on the earnings calendar, you have a lot of counters reporting their numbers, the likes of HCL Tech, Finance, Bajaj Finance, as well as Maruti Suzuki India and SBI Life. So keep an eye on those earnings reactions as well as earnings as well. But now when you look at corporate action, of course, there's a couple of AGMs, Mahindra Life and Mahindra Holidays and Resorts. So those will be in the spotlight, and what will also remain in focus is TIL Industries rights issue that opens. Motilal Oswal, because they'll be mulling a bonus issue. And of course, there's KSB Limited Board that will be mulling stock split as well. And it's of course the last day to buy ICICI Security for it's the last day to buy ICICI Securities for a particular thing. And then of course there's, in other news, there's Japan rate decision and Tokyo CPI, ExxonMobil and Chevron earnings as well. So those will also remain in the spotlight.
Well, absolutely. Today is a record date to be eligible for the dividend of ICICI Securities. So if you want to be eligible for that, today is the last day to buy shares of ICICI Securities as well. But let's move on and let's kickstart our coverage this morning with the macro data point that the market will be eyeing, the U.S GDP print. Growth in the United States has come in at much weaker than what was expected. Meanwhile, prices continue to soar at a faster pace. The Q1 GDP for the January to March period increased 1.6% on an annualized basis versus the economic forecast that pegged growth at 2.4%, following the 3.4% gain in the fourth quarter of 2023. While that was for growth, personal consumption expenditures, or the PCE index, rose 3.4% on a year-on-year basis. That, remember, is the biggest gain in a year and is up from that 1.8% print we did see coming in Q4. Important to note that growth has declined below the Federal Reserve's estimate for the first time in nearly 2 years. What's going to be bothersome for the central bank is to take a call that the slowing was coupled with faster inflation growth, which, if sustains, could be a dilemma for Jerome Powell and the FOMC going ahead as well.
All right, then let's also listen into what Geoff Dennis had to say about that as well.
To the release of the GDP report because of the poor earnings released by Meta, which had pulled down the Nasdaq futures prior to the GDP report. I think the earnings story generally across the U.S. market will remain reasonably robust. Of course, the market is definitely richly priced. I don't deny that at all. I think the point I'm trying to make is that we have got 3 CPI releases before the July FOMC meeting, and while I don't think the March PCE logically will give us a positive surprise, a lower than expected number, because you've got all this sort of, it's all baked in the cake to a certain extent, and Q1 was strong.
All right, then staying with US, Treasury Secretary Janet Yellen highlights that US growth is firing on all cylinders despite the miss. She still sees strength in the underlying drivers of growth and believes in the potential of the US economy, while of course noting that while the headline growth rate came in below expectations, it was for reasons that are peculiar and not really indicative of underlying strength, and that's the word coming in from her.
Alright, let's shift focus from the US to Japan now, and consumer price index in Tokyo grew substantially lesser than expected in April, sinking below that Bank of Japan target and therefore complicating expectations for a more hawkish stance from the central bank. Headline Tokyo CPI is up 1.8% on a year-on-year basis. The reading comes hours before that key Bank of Japan outcome where the central bank is widely expected to keep interest rates steady after raising them for the first time in 17 years in March. And on the back of this, as of now, Nikkei is not doing much. Nikkei is rather flat, just up 0.1%, a 48-point uptick coming in, but nonetheless in the green.
Let's also take a look at center our focus on some key earnings then that we touched upon a little bit earlier as well. Microsoft delivered better than expected Q3 results with a 17% revenue growth. However, revenue guidance came in weaker than expected as the management highlighted AI demand coming in higher than their available capacity, Meanwhile, Alphabet shares rallied on that revenue beat in their Q1 results. Company also announced their first ever dividend coupled with a $70 billion buyback.
Well, lots happening, so let's keep it going with tech. Intel also delivered better than expected Q1 results on top and bottom lines. Shares took a beating on that weak guidance, and Intel expects earnings of 10 cents per share on revenue of $13 billion at the midpoint. On the flip side, Snap shares rose on an earnings beat. Revenue surged 21% on a year-on-year basis. However, net loss deepened to $305 million.
Alright, time for a quick break then, but you don't go anywhere because when we come back, we'll take a look at how the Asian markets are faring.
Hello and welcome. You're still watching Market Cafe on ET Now. Now, as promised before the break, let's take you through what the Asian markets are doing as of now. And they're looking largely mixed today as investors in Asia are looking ahead to the Bank of Japan's policy decision and inflation figures out of Tokyo. Now that we've received, Tokyo's headline inflation rate for April came in at 1.8%, slowing from that 2.6% mark in March. And as we told you earlier also, these inflation numbers look pretty good. So, and traders will also be monitoring any steps that central bank takes to address the weak Japanese yen. On the back of this, Japan's Nikkei opened up with an uptick of almost 0.2%. It's right, they're not doing much. A 100-point uptick coming in for Nikkei as well. Moving on, let's also talk about Kospi. Kospi opened up with an uptick of 0.5%. It's almost gaining 1% as of now. Good move coming in for Kospi this morning as well. Shifting focus, let's talk about Australia because that opened sharply in the red. Continues to be there, a 1.3% cut coming in for Australia. 100 points lower is where that index is. Let's shift focus, also talk about what Hang Seng and Shanghai are up to. Hang Seng, good moves coming in, 225-point uptick, 1.3% uptick coming in, 17,500 is where that index is at. Lastly, let's take a look at what Shanghai is up to. Shanghai also up 0.5% in the green. So other than Australia, all markets as of now in Asia are looking pretty good. Shifting focus back home, we managed to close above the 22,500 mark yesterday at 22,570 for the spot, 22,575 for the futures, implied at 22,674, implying a good start for us, at least a 100-point uptick coming in from where we closed yesterday. So, well, we can expect a good start coming in, especially, that's a little debatable because the global handover is coming in a little weak, but Asian markets are doing pretty well, so mixed moves coming in. We'll just have to wait and watch where we open up this morning.
Welcome back. Thank you so much for staying tuned in. Well, credit card data of at least 17,000 new ICICI Bank customers has been exposed and reached the wrong users. Now, the bank has said that it has blocked these cards and is issuing new cards to the affected customers. My colleague Ankur Mishra is standing by with these details. Ankur, tell us a little more about this glitch.
Yes, sources say that Reserve Bank of India has taken a note of the instance which occurred at ICICI Bank. Remember, ICICI Bank acknowledged that 17,000 credit cards were mapped with wrong users, meaning one user can see the data of other users, and that includes CVV, that include name and other detail of credit card users. Now, the regulator has definitely taken a note of the instance and also asked bank for details. The bank is in constant communication with the regulator for the same, and only after it is satisfied with the reply which is being given by the lender, the regulator will think about the next step which, if at all, needs to be taken. Now, ICICI Bank has assured customers that all these credit cards will be blocked and replaced for the customers, and also if at all there is any financial loss, that will be appropriately compensated by the lender. This assurance is coming from the lender after many of the users had complained on social media platforms that they are able to view the data of other users, and that too credit card users. Now, this kind of instance occurred within 24 hours of Reserve Bank of India taking an action on Kotak Mahindra Bank regarding digital infra only, and now ICICI Bank had also reported a kind of glitch which would have happened on iMobile platform, and due to that at least 17,000 users would have suffered.
All right, Ankur, thanks for those details coming in. We'll see how this pans out for ICICI Bank today. And let's get a move on then. Take a look at all the numbers we did receive yesterday. Let's keep it going with the Nifty 50 companies. And let's take a look at Bajaj Finance first. And I'm going to take you through those numbers. Overall, an inline set of numbers when it comes for Bajaj Finance. NII looking largely in line, coming in at 8,013 crores versus 6,054 crores, up 28%. This is what we had estimated as well. Profit, that pre-provisions operating profit, PPOP, pardon me, has come in at 6,412 crores versus 5,119 crores, up 25.3%. Slight bit of a miss coming in over here on this front as well. Net profit, however, has come in at 3,825 crores versus 3,157 crores, which is up 21.2% on a year-on-year basis. Largely in line, but slightly better than what we had penciled in coming in at 12. Now, when you take a look at ROA and ROE, both of them have underperformed nominally compared to a year-on-year basis. And when you look at the sequential performance when it comes to NIMs, largely in line with what we were expecting as well, a 20 bips cut coming in at 10.3% versus 10.5% last quarter. Asset quality, slight bit of an improvement coming in on the GNPA front, but NNPAs have remained largely stable at 0.37% QOQ. Now, highlights over here, AUM has been up 34% like the management had guided. Deposit book has also increased by 35% on a year-on-year basis like the company had guided during the Q4 update as well. Cost of funds though is at 7.86%, a slight bit of an uptick coming over there, 10 bips rise coming in over there as well. The capital adequacy ratio has remained strong at 22.52% as well. Company has gone there and declared a dividend of 36 rupees per share. And good numbers coming in from Bajaj Housing Finance, which is the company's subsidiary as well. AUM is up 32%, NI up 11%. Disbursements are also up 26% on a year-on-year basis. Now, when it comes to the management commentary, they've said that they've made the required changes in response to the regulatory restriction that was put upon them by RBI for their e-com as well as Insta EMI card, and they've also written formally to the RBI for this. But going ahead, the management says that they're cautiously optimistic on FY25 profitability, and profit growth to be more rare ended on the back of moderation in NIMs in the first half of FY25, and ROA in the long-term guidance, they've given this guidance to be between 4.6 and 4.8%. So largely in-line set of numbers coming in for Bajaj Finance this time around. But let's also go across and listen in to what the management had to say about these numbers and what's their outlook going ahead as well.
Margin has been moderating because of rising cost of funds and gradual shift in AUM composition towards secured assets. We expect cost to peak in our assessment at this point in time by July, August, and AUM composition repivot towards secured assets to stabilize by September 24. Accordingly, we foresee a 30 to 40 basis points moderation in NIM over the next 2 quarters. From our current levels and then stabilize from there. Profitability remain cautiously optimistic about FY25, with profit growth to be a little more rear-ended due to moderation in NIM in the first half of FY25.
All right, then let's keep it going with Bajaj Finance. Bajaj Finance has formally reached out to the RBI requesting a review and removal of restrictions imposed on its loan dispersals under e-com and Insta EMI card. My colleague Ankur Mishra is joining us again with more details on this. Ankur?
Yes, Bajaj Finance has reached out to Reserve Bank of India for lifting of restrictions on 2 of its products. Now, the company has already made a formal application to the regulator and has asked for review as well as removal of the restrictions from regulator. Bajaj Finance has made all the required changes that is required by the regulator for complying, and it has also made an application, that to a formal one, to the regulator. Now remember, in November 2023 there were restrictions which were imposed by the regulator on Bajaj Finance, and that was there on 2 of its products, that is e-com as well as Insta EMI, and these were done because there were deficiencies which were found in the issuance of key fact statement. Remember, Reserve Bank of India had come out with digital lending guidelines, and after that there was a requirement of a certain format of key fact statement which was supposed to be provided to customers. Now the company is claiming that all the remedies which were supposed to be done for the products has been completed, and a formal application has been made to the regulator for removal of restriction.
All right, Ankur, thanks so much for taking us through that. Let's also take a look at what brokerages have to say on Bajaj Finance because while the numbers were largely in line, management commentary is slightly on the cautious side. So let's start by looking at what Macquarie has to say. They've maintained their neutral rating with a target at 8,100 rupees per share. They believe that the company is moving towards normalized earnings growth, and for their FI strategy, growth and return on assets are expected to decline. NIMs are expected to remain under pressure. Secured segments are likely to drive growth, and contingent buffers will continue to decline. So that's the view coming in from Macquarie. Next up, let's look at a rather different view coming in from UBS. UBS have maintained their sell rating target at 6,800 rupees per share, which is much under the current market price of the share. They believe that Q4 is in line, but elevated credit costs and products mix have weakened. So that is going to weigh on the performance going ahead. And this is on the back of the RBI embargo on e-com as well as Insta EMI cards. Rural slowdown could also be a challenge going ahead for the company. So FY25 overall could be a largely challenging year. Lastly, let's also take a look at what JP Morgan has to say. They've maintained an overweight rating on the stock, target at 8,500 rupees per share. They believe that regulatory restrictions are biting into ROAs while ROAs are starting to normalize. Loan growth will remain high, and removal of the digital ban is a key near-term catalyst, but we'll have to wait and watch as and when that happens, because we do not have a fixed timeline yet on when this removal of the digital ban is likely to happen. But yes, contrasting views coming in from Macquarie, UBS and JP Morgan on Bajaj Finance's Q4 numbers.
Absolutely, and let's see what the reaction is also in today's trading session. But moving on, then let's take a look at IndusInd Bank that reported steady set of numbers for the quarter gone by. When you look at the profit for the quarter, that grew 15% to 2,346 compared to last year, in line with analysts' expectations. But meanwhile, provisions fell about 4% compared to last quarter. This is what we got from the management also. Take a look at what they had to say as well.
Every bank should evaluate its technology infrastructure to keep pace with the scale in operations which you are doing. I think your UI UX capability which you are building, I think fraud management capability and KYC capability on real-time online basis, that you are able to weed out the bad accounts and the good accounts very well. And I think that's a capability which we have also, we've learned over a period of time. So it's not that we were born with this. So I think we've learned, but are we fully there? I think it's an evolution. And if you are doing the right things and you can demonstrate the right things, that is more important. And I believe this is one line where I don't put budgets onto it. So they have to continuously expand in this sector. And I think you got to be in compliance with the regulatory guidelines. You got to be in compliance with what the competitive environment is.
All right, that's the word coming in from the management of IndusInd Bank, but we also have my colleague Gaurav who's joining in to break down these numbers for us and make sense of them. Gaurav, hi, good morning. Take it away.
Talking about IndusInd Bank's Q4 FY24 numbers, if you look at net interest income, it increased almost by 15% on a YY basis. PPOP showed a growth of 7% because we saw cost to income increased in this quarter, and at the same time, employee expense as well as other expenses increased. And if you look at provisions, that actually declined, and that is why we saw PAT increase of 15%. Now, if you look at the numbers, those were fairly in line with what the street was expecting. Apart from that, if you look at some of the asset quality metrics, GNPA and NNPA remained stable on a quarter-on-quarter basis. Apart from that, if you look at net interest margins, that actually was a little down. So, for example, 3 basis point down on a quarter-on-quarter basis to 4.26%. But overall, if you look at the advances and deposit side now, advances mix is now at 56% retail advances, and at the same time, we saw retail loan book grew almost by 23% on a YY basis. Even in deposits, we saw 14.4% growth for deposits, and at the same time, we saw retail deposits grew almost by 151 basis points. Apart from that, talking about the asset quality, there were some plus points in this quarter's results. So, for example, gross slippage is actually reduced to 0.44% versus what it was at 0.56%. Even if you look at credit costs, that went down to 111 basis point versus the street's expectation of around 120 basis point, which is actually positive for the bank. Apart from that, bank also mentioned that they have contingent provision of 1,000 crore rupees, which was actually a key concern area during the last quarter's result. And lastly, if you look at any kind of improvement in the asset quality is actually positive for the bank, but we will need some kind of commentary coming up from the management on the back of the cost to income ratio, because that has been increasing, and that is now at 48.2%. So anyhow, the numbers were great, actually in line with the street's expectation. We would need some kind of commentary from the management, but overall, good set of numbers coming up from IndusInd Bank.
All right, thanks Gaurav for the earnings fine print, but let's also take a look at what the brokerages had to say as well. So when you look at the ratings coming in, flashing on your screens right now, when you look at Macquarie stands, they've maintained an outperform rating, and IFL also has a buy rating on the counter. But let's take a closer look at what Macquarie had to say then. They've, like I said, maintained that outperform rating, and when you look at the target, that is at 1,900. They've talked about lower provisions that were offset by higher OPEX. So that is something that Macquarie highlighted as well. And they're also saying that decline in slippages is a positive for this particular counter. They're also saying that IndusInd Bank remains one of their top picks in the space. So that's the word coming in from Macquarie. But when you take a look at what JP Morgan had to say, then they've also maintained a neutral rating. They have a target at 1,450. They're still waiting for a clean quarter from IndusInd Bank. And they're also saying that reserve drawdown aids the credit costs for IndusInd Bank. That is something that JP Morgan highlighted. But then when you look at what IFL Securities said, like I said, they have a buy rating on the counter, but they've cut the target price to 1,680 from 1,870. And what they've also said that is that going forward, they expect NIMs to be stable in the near term. In terms of elevated costs, they've talked about elevated costs amid franchise investment as well. And when you look at their estimates, they've cut financial year 25 to 26 estimates by 2 to 5%. In terms of ROAs then, they've also said that they expect stable ROAs versus decline that they're penciling in for some peers. So that largely is the word coming in from IFL Securities as well. And this is what the brokerages had to say.
Well, absolutely. And let's keep it going with all these Nifty 50 earnings, because yet another company that came out with its numbers yesterday is Tech Mahindra. They've reported revenue in line with estimates, but PAT falling slightly below expectations. Additionally, Tech Mahindra has announced a final dividend of 28 rupees per share. Now, USD revenue, which is the dollar revenue, stands at more than 1,500 million, showing a slight decrease, of 1.6% on a quarter-on-quarter basis. But here's what we also got from the management at the press conference. Listen into what they had to say.
As we step into FY25, we believe that this year will be better than the previous one. In a world of heightened geopolitical turmoil coupled with fast evolving AI capabilities, organizations will either have to address and adapt or defend and insulate their businesses like never before.
All right, well, let's also take a look at what the brokerages have to say on Tech Mahindra's numbers. And let's start by looking at what Macquarie has to say. Macquarie have maintained an underperform rating, target at 930 rupees per share. They believe that the company's ambition is to grow faster than peers by FY27. They have detailed plans to achieve these FY27 targets, and they're concerned about the 36% exposure to communication. So that is what Macquarie has to say. Moving on, let's also take a look at what Jefferies has said. They've maintained their underperform stance, but they've gone ahead and cut target prices to 1,065 rupees per share from 1,080. They believe that the company aims to boost growth to above industry average. They've cut estimates by 4 to 9% as the targets have been pushed to FY26-27. So that's largely the view coming in from Jefferies. Moving on, let's also take a look at what UBS has, UBS has written in their note for Tech Mahindra. Similar view coming in like Jefferies as well, because they have maintained their sell rating. Also cut target to 1,150 rupees per share from 1,200 rupees. They believe that the company will see highs and lows of execution for the plans in FY27, and they believe that FY27 targets will cater to investor concerns. This may seem like a turnaround candidate is what UBS believes. So that's the word coming in from UBS on Tech Mahindra as well. Lastly, let's also take a look at what JP Morgan is saying when it comes to Tech Mahindra's numbers. They have maintained their underweight rating, but they have raised target prices on the contrary to 1,100 rupees per share from 1,050. They believe that long recovery duration with the makes that they've provided and the demand will be key hurdles for the company going ahead. So, well, these are the views coming in across brokerages when it comes to Tech Mahindra. Largely coming in slightly on the bearish side, but you have JP Morgan that have gone ahead and raised target prices as well.
Well, absolutely, and we'll take a look at what the reaction is later in trade today as well. But let's switch focus then into Globe Aviation. The parent company of India's largest airline, Indigo, has agreed to place an order with Airbus for 30 A350-900 wide-body aircraft. With this new order, Indigo has entered wide-body space, and airline can use these aircraft to fly to global destinations as well. EDNA's Sumit Chaturvedi is joining in with more details. Sumit, looks like this international expansion is something that Indigo is setting sights on. Tell us a little more about this.
Well, India's largest airline, Indigo, has entered wide-body space with an order for 30 A350-900 aircraft. Well, they are long-haul aircraft, which means they are mostly used to fly on longer duration of more than 8 to 9 hours. They can connect big cities in Europe, in US as well. With this, Indigo has become first time the customer of this kind of aircraft. So far, this aircraft is with some airlines in India like Air India. So Indigo is going to compete with Air India on many global routes as well. Indigo has got the right to buy 70 additional aircraft after this. Indigo, meanwhile, we all know that it has got an order book of over 1,000 Airbus A320 family jets already, and this is another order that has gone to Airbus from Indigo's side. Last year in Paris, Indigo has announced a big 500 aircraft order for Airbus, and there it became huge after that. So far, Indigo is concerned, it is dominating Indian skies, but it plans to do it on global routes, and that's why it looks like this big order has been announced.
All right, Sumit, thanks so much for taking us through that. On the back of this news flow, Interglobe Aviation will be in focus in today's trading session. But viewers, with that, we'll just slip into a short breather on this edition of Market Cafe. More news and updates on the other side, so you stay tuned. Hi there, welcome back. You're still watching Market Cafe. Let's take a look at what the F&O snapshot is expected to look like today. How are the derivatives expected to shape up? And let me take it across to my colleague Ansh, who's standing by with all of those details. Ansh, we're at the beginning of a new series, in fact, the May series. So tell us what's expected today.
Right, so we had actually been hinting of a potential short squeeze in the market from last two sessions, as FII were very heavy on the shorts. And in previous session we did saw some good short covering happening, as FII in index future they covered around 82,000 short contract, due to which the total long position has gone up from 31.5% to 38.9%, and this was the biggest short covering seen in at least 3 years. Now this short covering was backed by massive 36% drop in total shorts by from 2.3 lakh contract directly to 1.47 lakh contract. Now moving on to Nifty. As you can see in the chart as well, Nifty actually gave a false breakdown from that 20 DMA, which actually triggered good buying in the market. Due to this, Nifty has given a mild breakout from that key resistance of 22,520. Now, in order to sustain this positivity, it needs to sustain about the 22,500-520 level. On option front, we are seeing call buying happening at 22,600, indicating traders expecting Nifty to go above this level and close there only. Whereas on downside, we are seeing put writing happening at 22,500, indicating good support base around this level. Moving on to Nifty Bank. As you can see in the chart as well, Nifty Bank made a similar pattern as that of Nifty as well, because even Nifty Bank touched 20 DMA and gave a good buying from that level. But it closed around its key resistance of 48,500 only. It needs to go above this to have a good positivity in the market. On option front, we are seeing call buying happening at the psychological level of 49,000. So traders are expecting Nifty Bank not just to give a breach of that resistance, but to go around this psychological level of 49,000 as well. Whereas on downside, we are seeing put writing happening at that psychological level of 48,000, indicating good support base around this level. Lastly, let's have a quick view on key stocks as well that will be in focus. We are seeing strong long build-up happening in Vodafone Idea, Bharat Forge and Axis Bank, whereas short build-up in Kotak Bank, Dalmia Bharat and Ramco Cement. So keep an eye on the stocks.
Well, absolutely, Ansh. We'll keep an eye on the futures and options roundup that you just outlined for us. But let's also take a look at stocks that you should keep on your radar this morning, starting with L&T Technology. And what you've seen on a quarter-on-quarter basis in terms of their earnings, their consolidated revenue has seen an uptick of 5%. When you look at consolidated profit after tax as well, uptick of 1% coming in there as well. And EBIT then has seen an uptick of 3%. And when you look at margins also, margins came in at 16.9% versus 17.2% for L&T Tech. So keep an eye on that counter and the reaction as well. But when you look at Cyient on a quarter-on-quarter basis, what you've seen is the consolidated revenue has seen an uptick of 2.2%, while the profit after tax has also seen an uptick of 29% coming in for Cyient. When you look at EBIT, then that also saw an uptick of 3% thereabout. And when you look at margins came in at 14.4% versus 14.3% on a quarter-on-quarter basis. So that is an uptick of about 10 basis points coming in for Cyient in terms of margins. But moving on then, let's also take a look at Himadri Specialty. That will remain in focus on account of the consolidated revenue from operations coming in with a 14% uptick and a profit after tax figure coming in with a solid 51% uptick there. They've also approved brownfield expansion of a new specialty carbon black line of 70,000 MTPA at an estimated capex of rupees 220 crores. So this counter will also remain in focus, and so will Som Distilleries. So let's take a look at their earnings fine print as well. In terms of net revenue, they've seen an uptick of 51%. When you look at profit after tax, they've seen an uptick of 18% as well. Lastly, Electra Greentech as well. On a year-on-year basis, when you look at their revenue, that came in with a downtick of about 23% on a year-on-year basis, and net profit also came in with a downtick of 46% year-on-year. So largely, these are the counters that you should keep an eye on.
Well, all right, we'll be keeping a close eye on all of these counters in today's trading session, but let's keep it going with the earnings that are all set to be reported today among the Nifty 50 pack. One of the 5 companies coming out with its numbers today is Maruti Suzuki, all set to report its Q4 earnings. Both the top line and bottom line are expected to expand on a year-on-year basis. My colleague Shrishti is here with what we can expect from these numbers. Shrishti, take it away.
So this time we are expecting a good set from Maruti Suzuki, because look at the run up in the volumes and the jump in the volumes, because on a quarter-on-quarter basis, the overall volumes have seen a jump of almost 17%, while on a YOY basis, the volumes have inched up close to 13.5%. And also, if you look at the mix of their UVs in the overall portfolio, that is now zoomed to close to 37% in Q4 of FY24 versus just 26% in Q4 of FY23. So all in all, great set of numbers expected from Maruti Suzuki, and hence we are seeing the stock is also seeing no stopping. But when it comes to the overall numbers, on the revenue figure, we are expecting 38,860 crores. That will be a jump of 17% on a quarter-on-quarter basis. If we talk about EBITDA, close to 5,000 crores is what we are expecting. And also on the margin front, we are expecting an improvement on the back of the better pricing as well as benefits from the operating leverage. 13% is what we are expecting the EBITDA margin, and that's versus 12% that the company clocked in Q3 of FY24. And lastly, on the profit figure, our expectation is of 3,046 crores, though that will be a flat growth on a sequential basis. But nevertheless, the key to watch will be the margins of the company, where this time around 13% is our expectation. But apart from the company's earnings and all of these numbers, we will be watching out for company's commentary on the entry-level segment. How are they seeing the sales of the hybrids, and what are the future plans? If there are any more further and interesting details about their upcoming EV launch, we will be tracking all of those details. So all in all, good set expected from Maruti Suzuki, and 13% of margin is the key to track.
All right, thanks Srishti. We'll keep an eye on Maruti Suzuki, but let's also keep it going with earnings. Then HCL Tech is also all set to report its Q4 numbers. What is the street penciling in for HCL Tech? Anisha is standing by with that roundup. Anisha?
Well, the seasonal weakness is going to impact HCL Tech's performance, and that's why we are expecting only a growth of 0.3% on the top line. The margin is expected to dip quite a bit, in fact 100 basis points, and the profitability in tandem will be down 7%. Remember, Q3 is seasonally the strongest quarter for the products and platform business of HCL Tech. This time that won't be there as a tailwind, and that's why there is going to be a bit of a sluggishness in revenue. There could be a positive contribution from the 1-month impact of the Verizon contract, but that's of course something which is going to be a bit limited. Lower margin of Verizon contract, as well as the fact that there is going to be a decline in products business and wage revision, all of this would mean that there is going to be softness in margins. Deals are expected to be healthy around that $2 to $3 billion mark. Of course, the other important thing to watch out for is the FY25 guidance. At an overall level, there might be a revenue growth guidance of 6 to 8%, wherein we are expecting that 5 to 7% growth might be on organic basis, and the margin guidance is expected to be 18 to 19%, and overall management's commentary on the outlook will be important too.
All right, Anisha, thanks for that roundup on what we can expect from HCL Tech. Viewers, with that, we're completely timed out on this edition of Market Cafe. From Shayan, Simi and the entire team that put this show together, thanks so much for watching. But while we bid you goodbye, you stay tuned to the channel because the market takes all the action ahead.